The U.S. stock market is a barometer for the country's economic health, and its movements reflect the pulse of both domestic and international market forces. On April 3, 2025, the stock market experienced a dramatic crash, primarily triggered by President Donald Trump's announcement of a new series of tariffs on foreign imports. The imposition of these tariffs sent shockwaves through the global economy, with widespread repercussions for both investors and everyday Americans. This essay will examine the causes of the crash, the economic consequences of such tariff impositions, and the broader implications of President Trump's trade policy on the U.S. and global economies. President Trump's administration, particularly during his first term, was characterized by an America First economic policy, which included renegotiating trade deals and imposing tariffs on foreign goods. Despite leaving office in 2021, Trump has maintained a strong influence on American politics, continuing to advocate for protectionist measures aimed at revitalizing American manufacturing and reducing the trade deficit. On April 3, 2025, Trump took a bold step by reinstating tariffs on a wide range of foreign imports, most notably from China, Europe, and other key trading partners. These tariffs were ostensibly aimed at protecting American workers from what Trump termed as unfair competition and job-destroying trade practices. However, economic experts and analysts quickly recognized that such a policy could have significant downsides, particularly in the context of the current global economic landscape. While protectionist measures might offer temporary relief to certain sectors of the U.S. economy, the broader consequences, especially the negative impact on consumer prices, international trade relationships, and investor sentiment, were swift and severe. The announcement of new tariffs triggered an immediate and sharp reaction in the stock market. The Dow Jones Industrial Average, S&P 500, and NASDAQ all experienced significant declines. Within hours of the announcement, major U.S. companies with global supply chains saw their stock prices plummet as investors feared that the tariffs would disrupt their businesses and lead to higher costs. The imposition of tariffs also raised concerns about retaliatory actions from other countries. The prospect of a full-scale trade war loomed large, which further spooked investors and contributed to the market downturn. As uncertainty grew, many investors fled to safe haven assets such as gold and government bonds, further exacerbating the market sell-off. While tariffs are often presented as a tool to protect domestic industries, they can have profound negative effects on the broader economy. One of the most immediate consequences of tariff impositions is the rise in consumer prices. As businesses face higher costs for imported goods, they are forced to pass those costs on to consumers. This could lead to higher prices for everyday products, from electronics to clothing to food, further eroding household purchasing power. For businesses, the situation is equally grim. Companies that rely on foreign imports for raw materials and components find themselves facing increased costs, which can harm profitability. In some cases, businesses may be forced to raise prices to maintain their margins, while others may reduce investment or lay off workers. The prospect of a prolonged trade conflict also deters investment, as uncertainty about future trade relations makes it difficult for companies to plan for the long term.